Did you know that if a foreign national sells real estate in the United States, the IRS can automatically take a big chunk of the sales proceeds before the seller even sees the money? This isn't a rumor, it's called FIRPTA, and it can mean thousands of dollars withheld at closing. Welcome to the Freedom Group channel. Here we help individuals and businesses understand complex topics like taxes, real estate, and financial planning, so you can make confident decisions. Freedom Group is made up of 3 companies that have proudly served our community for over 20 years in the areas of taxes, accounting, insurance, financial planning, and real estate. We provide complete support for both your business and personal needs. Today, we're diving into how FIRPTA tax withholding works when a foreign national sells U.S. real estate. We'll explain what FIRPTA is, why it exists, how the withholding is calculated, and what options sellers have to reduce or recover it. If you're buying or selling property in the U.S., this information is critical. FIRPTA stands for Foreign Investment in Real Property Tax Act. It's a U.S. tax law that requires buyers to withhold a portion of the sales price when purchasing real estate from a foreign seller. The idea is to make sure that the foreign sellers pay taxes owed on gains from selling U.S. property before they leave the country with the proceeds. Before FIRPTA, foreign sellers could sell property in the U.S., make a profit, and then leave without paying capital gains taxes. The IRS had no easy way to collect from someone outside the country. FIRPTA was enacted to fix that. It shifts the responsibility to the buyer to withhold funds and then send them directly to the IRS at the time of the sale. Here's the basic process. When a foreign national sells U.S. real estate, the buyer must withhold a set percentage of the total sales price, not the profit, and send that to the IRS. Currently, the standard withholding rate is 15% of the gross sales price. So, if a foreigner sells a property for $500,000, the buyer withholds 15% or $75,000 and sends it to the IRS. It's important to remember that this withholding is not necessarily the exact tax owed. It's more like a prepayment or security deposit to ensure the IRS gets what's due. The actual tax is calculated when the seller files a U.S. tax return for that year. If too much tax was withheld, the seller can request a refund. If not enough was withheld, the seller may owe more. You might ask, can the withholding be reduced? Yes. In some cases, the withholding amount can be reduced. For example, if the actual gain is much smaller than the 15% sales price, the seller can apply for a withholding certificate from the IRS before closing. This certificate can authorize a lower withholding amount that matches the estimated tax owed. However, timing is crucial. You need to apply early because the IRS must process it before the closing date. Under FIRPTA, the buyer is legally responsible for making sure the withholding is done correctly and sent to the IRS. If the buyer fails to withhold and the seller doesn't pay the tax, the IRS can go after the buyer for the full amount, plus interest and penalties. This is why most real estate closing agents are very careful when a seller is a foreign national. There are some exceptions to the FIRPTA withholding. For example, if the buyer is purchasing the property for $300,000 or less and will use it as their personal residence for the following 2 years, FIRPTA withholding might not apply. Also, certain types of ownership structures or treaty benefits can affect the rules, but these exceptions are specific and must be documented properly. Let's walk through a simple example. A Canadian resident sells a vacation home in Florida for $400,000. The buyer withholds 15%. That's $60,000, and sends it to the IRS. At tax time, the seller's actual gain is only $50,000, and the tax owed comes out to $10,000. The seller files a tax return and gets a $50,000 refund. This is why it's so important for sellers to know the process and keep good records. If you're a foreign national selling property in the US or a buyer purchasing from one, FIRPTA can be a complex process with big financial consequences. Working with experienced tax and real estate professionals can save you time, money, and headaches. Here at Freedom Group, our team helps clients navigate FIRPTA from start to finish, from calculating withholding to filing tax returns for claims of refunds. In conclusion, FIRPTA exists to make sure taxes on U.S. real estate sales are paid, or even when the seller lives abroad. It's not a penalty, it's a collection method. Understanding how it works can prevent surprises and ensure you keep as much of your money as possible. If you found this information helpful, be sure to like this video, subscribe to our channel, and turn on notifications for more expert advice. And if you're ready for personal guidance, schedule a consultation with us today. Next, I recommend watching our video on how to avoid or reduce FIRPTA withholding. You'll see it right here on your screen now. Thanks for watching, and we'll see you in the next video.